Hello, everyone. Welcome to today's session. The topic is why your business could worth more than you think. All right. Before we go to the main content of the session, a quick declaration. The information provided is for general guidance only. We recommend consulting an experienced tax advisor or planner before making any decisions. Also, we're not licensed financial planners and cannot provide advice on financial products. For detailed assistance, please consult a licensed financial planner. All right. Okay, let's have a look why your business could worth more than you think. Okay, one major value you might have missed would be missed tax saving opportunities. Okay, so almost actually 100% our new business clients when they're coming on board, we notice that there are missing opportunities. For example, uh, you might not know that you can employ family members, okay, including minors below 18. Okay, so the tax law requirement is when they're receiving passive income, there could be penalized tax rates. But if they're earning active income, it's treated as accepted income, and then they do still have the tax-free threshold of $18,200. Okay, so yeah, make sure if you do have them family members helping you, you pay them properly and treat them as employees. Okay, and also there are FBT exempt benefits. So when you're providing office meals and refreshments to employees, and then also minor benefit below $300, you can actually claim a deduction in the business structure, and then employees can take the benefit away tax free. So of course, office meals need to meet tax office requirements. Yeah, most of our business clients will already know about the requirements. Okay, and then minor benefit below 300, you can actually do it multiple times, provided each time below $300, and then is given out infrequently, irregularly. It can be gift cards, it can be other type of benefits to employees, including family members and business owners. You can actually provide the benefits tax free. Okay, and it's also, of course, deductible for the employer, the business structure. And then also there are allowance paid to employees, travel allowance, overtime meal allowance, provided if they're below tax office required threshold. Again, also eligible. Okay, the employees can take away the money paid to them. Okay, tax free, and then the employer or the company or business structure can claim the allowance as deduction for the business structure. And of course, there are so many other strategies similar to this. We have probably 50 plus strategies for business owners. And then we only just mentioned a few here. Yeah, if you're interested, talk to us. We do have other YouTube sessions that might include some other strategies. Yeah, but you can also book a free consultation with us to find out. Okay, see and basically find out how much value we can help you to add to your business. Okay, of course, the other part that a lot of people don't know, basically what we covered just now was on year-to-year current tax savings. And then a lot of company business owners don't know that company tax paid in early years could be refunded to shareholders with low income in later years. So when the structure is actually with family trust as shareholders, it's going to be more flexible. So I've included an example here. Let's say year one, for a base rate company, okay, 25% tax rate. If the taxable profit is 100K and income tax rate 25%, okay, the amount will be 25K. Let's say after a few years in year end, the company declared a dividend payout of 20K to an individual shareholder or a trust beneficiary with no other taxable income. So at the moment, the income tax free threshold is 18,200, but there's also $700 tax offset for low income earners. Okay, so combined together, when someone's earning 20K, no tax, okay, tax free. And then so on that 20K, dividend payout, there will be a 25% tax paid already on the company tax. Okay, it's called franking credit. And then basically the franking credit will be refunded to the individual taxpayer's hand. Okay, $5,000. So basically through this strategy, you can reduce the long-term income tax rate for company structure to 0%. Okay, potentially. All right. So of course that's going to add more value to the business structure, to the company structure. All right. Next one will be more on the financial planning side. As some of our clients already know, I do have a master degree of financial planning, even though I choose to not having a license because there are too many government protocols. We have to increase our price sky high, and that's not something I want to do. Okay, but anyway, this section is more focused on financial planning. Okay, let's say if you diligently invest surplus cash based on risk preference and time frame, that will help you to maximize your future wealth or future value of the business as well. And then potentially you can consider bank loan for investment because the whole purpose is to utilize the bank's money to earn your own income or return. So let's say, for example, what if the bank interest is 6% and you have an investment opportunity for 8%? Then of course, by utilizing the bank's money, you are gaining 2% every year on your own income. Okay, return on investment. All right, and then of course you also need to consider structure. So what type of structure you want to utilize? Super fund could be a very good choice depending on age and financial goals. So of course, for someone who's close to retirement, as much as possible, utilizing your business structure. Okay, have a look at the cap. Okay, current cap is 30K for concessional super contribution. You can also do a catch up, carry forward contribution, yeah, up to 5 years. Okay, so then maximize your deduction outside super. Also, you can invest the surplus cash inside super fund to achieve the 50% of income tax and 10% of future capital gains tax when you're selling an asset. All right. So I've also included a warning here because recently it happens to quite a few of our clients. So they actually just put a big amount of cash in the bank and at the end of the year actually pay quite a big tax bill on the interest income generated from the bank saving account. Okay, so but the issue is, let's say, what if the saving account will give you a 4% interest income, and then if your marginal tax rate is 32%, let's say if the bank account is kept in your personal name, or even if it's a company structure, 25%. Okay, after you reduce tax, okay, the after tax interest or income, let's say it might be 3%, or if your marginal tax rate is 32%, maybe less than 3%. And what if the current inflation is 4.5%? So your money in the bank will reduce in value every year. Okay, the value of the power you can use the money to purchase every year is going to increase. All right, so be very careful. Okay, when you have a large sum in your bank account, it's not a perfect investment. You need to look around, see whether there's another better investment that at least will give you a return that's going to beat inflation. All right. All right. That's everything I wanted to mention in today's session. Here is a brief introduction about myself. Okay. And also our contact details here. If you have any questions, feel free to check with us. Of course, if you're a business owner, make sure utilize a free consultation with us if you're not our client yet. And then we're going to introduce other planning strategies to you to show you how much more your business actually worth for you. Okay, how much value we can help you to add. All right, just send us an email. Let us know. All right, thank you so much for attending today's session. We'll see you in our next YouTube session.